Good morning, everyone. Welcome to this update for global stocks and commodities for the 16th of June. We've got a situation that comes along every now and again, and I suspect is going to become more regular, and that is this conflict between negative sentiment and the reality of the market and the economy. I think we're in for a lengthy period where volatility is going to just keep revisiting as this tussle between the wall of worry, if you like, and the reality of the market plays out. So that's the essence of today's video. There is a lot that people have got to worry about, and the natural human inclination is that you extend a potentially bad situation to being a disastrous situation. That's really just how we're wired. But the reality is that the S&P index is only 2% off its all-time highs. So either the market has got it completely wrong, or we've just got another situation where the wall of worry is just being overdone. So that's what I want to try and pull apart a little bit today. I've got the normal focus on various stocks and commodity trends. And Portfolio Analyst last week, we started, as I promised, the start of what for me is going to be a multi-year journey of education and opportunity on identifying, particularly in Australian small caps, the 10 bagger stocks that can, over a period of years, produce a really tremendous outcome. And I know I got a few emails that were a little bit skeptical about the possibility of getting 10 bagger outcomes, and I understand that, but I just ask people to look at the reality. If you're across the market, these sort of stock outcomes occur far more frequently than what you would perhaps think. And it's really just a matter of planning and patience and long-term discipline execution, and you can get access to the sorts of outcomes that hardly anyone ever gets in their trading or investing lifetime. So that's going to be a part of Portfolio Analyst on an ongoing basis. All right, turning to the market. The S&P slightly better than flat for the week. It was up and down a little bit, and we've seemingly got this conflict between all the things that people are fretting about. There is slowing global GDP. There is a trade war. We've got some nasty events brewing in the Middle East. We've got Brexit. We've got China. There's all manner of things to worry about, but that's always going to be the case. There's always going to be something out there that could be a potential disaster. And on the other side, we've got the reality of what the US economy is doing, what stocks are doing, and where the market is actually sitting. Now, the US dollar had been sold down over the previous few weeks, but reversed quite sharply and shot back up again. So we'll take a look at that. But Treasury yields did manage to steady, so they held at the same level as last week, just over 2%. So let's jump in and start with the S&P. So you can see here are the all-time highs at around 29.50. We had an ABC dip. There's our A leg. There's the little B recovery, and then there's the C leg to complete that correction, and took us back down to the lows of March. So that's all played out, and then we got a very significant rebound. And the other part of the rebound is not just the fact that, pardon me, that it went up to within 2% of the all-time highs, but this is really broad-based participation in the market. All sectors are joining in. This is not just about some large cap stocks that are carrying the flag for the index as a whole. It's very broad, the participation. So this is very positive. What is actually being seen in the market in the US at the moment. So that's the S&P. There's really nothing much that you can conclude from that, other than we got this significant disturbance in the final quarter of last year, which was around the market taking fright that too much stimulus would be withdrawn from the market too quickly. That seems to have put a cap on what central banks can do in terms of getting back to normal. We've now reached that level at a historically low level, and as I covered last week or the week before, that is a bit of a worry on a big picture level because it demonstrates that the central banks have got less and less capacity to rev the global economy up. And so eventually that, I think, has to end with some probably fairly substantially negative outcomes. But as I've repeatedly say, that could be years away, and therefore it's not something that really should come into your thinking at this point in time. So that's the S&P, all looking fairly positive, and I might add as well as the market reality only being 2% off the all-time highs. Revenues and profits for US companies are still pretty healthy. And if the current 2019 and 2020 earnings per share forecasts are actually achieved, and there's no reason why they won't be, because American companies tend to play this dance where they underpromise and overdeliver. So it would take quite a significant change in the American economy for these the current forecasts for the next this current year and next year not to be met. Then, if that's the case, then the S&P is trading at its lowest PE multiple in 8 years. So, remember that fact the next time some bearish commentator wants to tell you that the American market is historically overvalued on every metric that you could possibly imagine, because it's just not factual. It's just cherry picking the pieces of data that they want. So stock markets are forward-looking beasts. They are not backward-looking beasts, and therefore, if you want to draw a valuation comparison looking backwards, but perhaps when interest rates were higher, then it's just a completely erroneous way to compare things. You've got to look forward, and so therefore, assessing valuation on a forward PE to me is the only sensible way to go about it. And as I said, the S&P would appear to be at an almost decade low in terms of valuations. So that's the reality of what we've got. The other final point that I would make on this too is that the S&P, or sorry, not the S&P, the general sentiment amongst business and consumers is just too poor for a top in the market. You do not get tops in the market, particularly major tops, when sentiment is as poor as it is. So that's why I'm pretty confident we're not going to see any disasters, at least in the foreseeable future. All right, while I'm here, let's just check in on the US dollar. So we've got quite a decent uptrend channel running, which has been going now for some time. You can see we had the lows back here in March, April last year. Got a nice uptrending channel. We got ahead of the channel. We came back down to the bottom a week or so ago, and then we had quite a nice surge last week. So the US dollar still in basic uptrend as far as I'm concerned. This is the Aussie dollar. We did have a retrace attempt, which is pretty normal, back to the 70 cent breakdown level, and then several gaps during the week, and we ended up basically right down at the lows. And you've got to go back to, we've got to come all the way back here to January of 2016 to see where the Aussie dollar was last down at these sort of levels. And you would be a brave person to think that the Aussie dollar couldn't break 67.2 and then head down further, particularly if we end up having the rate cuts that are being discussed. So the Aussie stocks, the Aussie dollar down fairly sharply, and of course the big debate now is, will we go under the 1% threshold on the cash rate in Australia before the end of the year? I think it's probably fairly likely that we'll get there. Whether it happens this year or happens sometime in 2020 is probably a point not worth dwelling on too much. The government will probably have to step in with some additional stimulus, which is something that we don't traditionally do. So it's going to be a very interesting 12 months in the Australian economy. Our index, however, is quite buoyant, up 110 points for the week, and I think that's, to my way of thinking, it defies the reality of the Australian market. So this is kind of the reverse, in a sense, on the Australian economy compared to the US. Many household names, top 100 household names, are downgrading. They're reporting to the market that things are going to be worse, and even former darling stocks like Challenger, which everyone thought was a no-brainer because everyone would be buying annuity streams for their retirement, and even Challenger, which I've been saying for 3 or 4 years was significantly overvalued, and the chickens are coming home to roost on stocks like that now as well. So my overwhelming advice is don't go with mainstream thinking on the Australian top 100 because I think there is far more risk there than any potential reward would justify. The reality is that growth stocks, and there are still growth stocks that you can buy which are not at excessive values, are the only place to be. And it gets back a bit to the old adage, if you're not growing, you're dying. And I think very low growth companies are not where the attractive risk reward is to be found at the moment. So let's just have a quick look at the ASX 200. So quite a strong week, and we're not that far away now from the 2007 highs. So that came in at around 68.40. We finished the week at 65.50, so we're only about 300 points below that level, which is sort of defying my expectations. I've certainly been wrong on where I thought the ASX 200 would go, but look, I don't place too much stock in it anyway because it's just a representation of such a small sliver of the Australian market that and they're not stocks that I tend to trade anyway. Gold had a strong week despite the fact that the US dollar went up as strongly as it did. There's the weekly chart on gold. You can see that the uptrend is still in place. We've got a bigger picture overall wedge, and we do need to get above 1380 for a breakout. But given the week that we've had, or the 2 or 3 weeks that we've had, and particularly last week, I thought was incredibly impressive with the US dollar going up as it did, and for gold to basically hold steady, and at one stage was trading at 1359, was a pretty impressive performance. So there's the daily. You can see even on Friday, we were at the highs, we were trading at 1359, and finally the currency effect came in at the end, just in the last couple of hours, but very impressive on gold. And let's look at GDX. So GDX, we've had this resistance line that's been in place since September of 2017, and we're just starting to poke above that now, and you can see that GDX is finally starting to outperform the S&P index, which is this line at the bottom. So you can see this is the ratio between GDX and the S&P. It started to rise. It's back above the simple moving average, and therefore outperforming the S&P. So certainly interest coming back into gold and gold stocks. So precious metals, gold pretty buoyant at 1342, and that translates to an Australian dollar gold price, which is extremely buoyant at 1953. So no wonder the local stocks are doing well. So I've pretty much covered all that. So gold stocks, I said last weekend that they'd have a strong week, as they did, given what gold was doing. And it's pretty hard to see them not having another pretty good week next week as well. Turning to other commodities, copper steady at 264, which again was pretty good considering the strength in the US dollar. But look, you've got to recognise that these movements in the short term are a lot about the futures market trying to guess what comes next. And I think copper had probably been oversold in the futures market. Crude oil dropped back a bit as well, dropped back about $1.50. And this whole energy space continues to be a bit unpredictable for me. So I would just avoid it for now, unless you're just a long-term holder in the energy sector. And there's the spot copper chart, not much change there. And also oil. So to wrap it up, the current positioning, investors sort of feel back on safe ground a little bit, as I said last week, because of what's happening with the central banks. And I think that's the primary reason why the S&P is back within 2% of the all-time highs, is that people feel that the Fed's got their back. But the questions that remain unanswered and no one can answer is, will the trade war escalate from here, or will America and China reach some sort of token agreement? And I think if there is any sort of agreement, it would only be token, because there is just a massive ideological gap between where China is and where America is that's not going to be resolved anytime soon. So I think that's pretty obvious now. But we may get some sort of token agreement just to keep their economies ticking over. And Trump certainly has to have an eye to the elections next year. He's in a difficult position where he's got to get a win to impress the electorate, but he's got to get a win on terms that appear to be favourable to the Americans. And the Chinese, they don't have an election, so they don't have time pressure that Trump has. So it's going to be really interesting to see how this plays out. But then again, the Chinese are really feeling some heat on their economy. The potential problem area for me might be if China does decide to devalue the yuan. That could be quite destabilizing for markets in the short term. We've seen that in the past. It would be disruptive to their economy, but it would certainly hurt the US as well. So it's a dangerous but fascinating situation between the US and America. The other question that we also don't know the answer to, we've definitely got a level of declining consumer and business confidence. And will that lead to some sort of self-propelling spiral where it causes consumers to close their wallets, it causes businesses to invest less just because of the uncertainty? So it's not beyond the realms of possibility that the uncertainty could turn into hard reality outcomes. I hope that's not the case, because it would be a pity for many years of hard work to be undone. But look, that's where we find ourselves. So I think in this sort of environment, there's no need or necessity, I don't think, to do anything drastic in the market. But I would just be demanding an extra margin of safety. I think that's just the way to go. You can there are still some wonderful opportunities to make some terrific profits in the market, but just demand an extra margin of safety in doing so. Portfolio Analyst this week is really moving now to the next step. So this is a multi-year program for me. I'm really focused on getting members, giving members access and assistance with the execution of some of these stocks that are going to go up many times their current price over the next few years. And so it's really just the next step in setting up that monitoring program. There is my contact details for any non-members that would like to communicate with me, and I will be traveling over the next month on and off. So there will be some weekends where I just don't have the opportunity to present this. Please bear with me, but need a little bit of a recharge of the battery from time to time. There will be also some of the videos will come probably at a different time as well. But anyway, hopefully you'll bear with me over the next month, and we'll see how this fascinating market unfolds. That's all for this week. Cheers.